Welcome to the video lecture on Chapter 1 of your text. In this chapter, we talk about where financial accounting standards came from and why we need financial reporting. I'd like to start this chapter with just a discussion of why financial accounting exists, and I'll give you a brief scenario that kind of, I think, makes it pretty clear why we need reporting if we're going to try to choose from a variety of options that are available to us. So why does financial accounting exist? Here's evidence from a used car sales scenario. So if I was going to buy a used car, if I went into the used car lot and saw two identical looking cars that I could choose from, and I knew that one of them had a $10,000 value to me because it ran, and the one has no value because it doesn't run. Again, these things are identical looking. And I have to decide which one I want to buy if I want to buy a car as a customer. I can't test drive the car, and the dealer is not disclosing anything about the cars. In this scenario, what would you offer for a car, right? As a customer, you probably would offer $5,000 for a car. There's a 50-50 shot you're going to get that $10,000 car, so you offer $5,000. On the other end of the deal, the used car salesman knows that one of the car runs and one car doesn't run. What car is he going to sell to you? Well, used car salesman, if he's smart, he'll sell you the car that's worth nothing, right? So the customer is going to spend $5,000 on a car worth nothing. The customer would never ever participate in this market for used cars. So the way that we solve this problem so that customers actually participate in the market for financial securities is accounting disclosure. A more intricate version of this story actually forms the basis for Akerlof's 1970 paper that won the Nobel Prize. So, it sounds like a simple kind of setup here, but that won him the Nobel Prize. So that's why we need disclosure, so that markets can actually work. Another way of saying this is that we need, why is financial accounting important? Because it allows us to have efficient economic resource allocation. So customers for stocks that want to participate in the stock market, you want to make sure that they're applying their money to the proper companies, and that companies that need funding get funding from potential stockholders. So what's the objective of financial reporting? Well, we want to provide external users with information that's useful in investment and credit decisions. We call that decision useful. So investors, creditors can effectively invest in the right companies that are going to succeed in the future, companies that are going to pay back banks. They're effectively, with the right information, these investors and creditors are able to make the right decisions about who to give money to. Decision useful, when we talk about decision useful, we typically say that the information is useful in assessing future cash flows, or useful in assessing firm resources, claims to resources, and changes in them. So this is the information that might be useful to you as an investor. If you're an investor, you want to make sure that the company is going to make money in the future. You can try to assess future cash flows. If you're a creditor, you're also interested in that information. You also want to know if other people have lent this company money, if they're solvent, if they're able to pay you back, if you lend them money. So that sort of information is important. That's the objective of financial reporting. But primary users are investors and creditors, but there's also a wide variety of users of the financial reports. So I think we'll talk a little bit more about that later. So we want decision useful reports, right? These decision useful reports are also, it's important to know, important to have uniform rules, because decision useful reports also allow comparisons across companies. If we had a whole different set of rules for every company, I don't know how I would compare company A to company B. So the reason that we want uniform rules is so we can make comparisons and make decisions. And generally accepted accounting principles is how we arrive at uniform rules. So it's a uniform set of accounting principles that companies abide by when they put together their financial reports. So generally accepted accounting principles include both standards made up of various rule-making bodies and also some current accounting practices that have evolved over time. So we'll talk about how this happened. We'll talk about the history of financial reporting. Before and during the Great Depression of 1929, financial reporting was entirely voluntary and unregulated. So you had lots of companies disclosing lots of different things about themselves. And that was one of the reasons, one of the things that led up to the Great Depression. People were invested in companies that were not comparable to each other. Companies were reporting things fraudulently. So in response to the Great Depression, the U.S. government issued two acts, the 1933 Act and the 1934 Act. The 1933 Act applies primarily to initial public offerings. So when companies initially are trying to raise funds through issuing stock or bonds, the 1934 Act applies to secondary markets. So if you go and try to buy Apple stock from the New York Stock Exchange, that's a secondary market. The 1934 Act is what we're going to primarily discuss in this class because it relates to all the financial statements you're used to seeing, the 10Ks and things like that, annual reports. The 1934 Act also generated the SEC. The SEC has responsibility and authority to set accounting standards that are publicly traded, but it delegates this task to private sector bodies. So currently the people that create the financial accounting standards are the FASB. So we'll talk about that. So, this is how we set standards for financial reporting, for accounting standards. Congress delegates authority to the SEC. The SEC delegates the authority to set standards to the private sector. And right now, the FASB is the one that produces the financial reporting standards. But in the past, it's been the APB and the CAP. These are all older standard-setting bodies. Some of the standards that they set are still part of the FASB today, still part of GAAP today. So we'll talk about how you can navigate all these, rules that are out there. How GAAP is so it's just everywhere. There's lots of different people who came up with GAAP. So we'll talk about how you can kind of navigate that in a couple slides here. So we'll talk about the parties involved in this. The SEC and the FASB we talked about already a little bit. The ICPA is also here. The SEC is the agency where the U.S. government delegated the enforcement of federal securities laws to the SEC. So the SEC enforces security laws and regulates the securities industry. They're in charge of setting standards, but they delegate that to the FASB, the FASB, which is the organization that generates accounting standards. It's independent, private sector body whose members represent a broad constituency of interest groups. So we'll talk a little bit about the political motivations for accounting standards too. But one of the evolution of these standard-setting boards ended up with the FASB because some of the prior ones didn't represent lots of different companies when they're coming up with accounting standards. But the FASB does, and I think that's been a solution to the political problem with coming up with financial accounting standards. And the other thing here is the AICPA. It's a national organization of certified public accountants. So if you go try to get your CPA, you're going to go through the AICPA. They're the ones who are going to administer the test, it's the group that you become a part of when you get your CPA. But in the past, they were also a standard-setting body because they created the committee on the CAP and the APB, which we talked about before as previous standard-setting bodies. So those are the three kind of groups involved in standard setting. Again, this thing is a political process to come up with accounting standards. There's lots of people interested in the accounting standards. There's investors, there's academics, there's the AICPA, which is all the CPAs, right? They're all interested in what the accounting standards are going to be, how it's going to change their job. There's the CPA firms. There's businesses. They're all very interested in what the accounting principles are going to end up because it affects the way that they report their performance. And lots of companies, lots of managers are their compensation is based on performance. Because managers' compensation is based on what's in the financial statements, they're very interested in changes to the financial statements. Financial community, analysts, bankers, they're trying to come up with a prediction of the future for a company. Preparers, financial executives, I talked a little bit about that. Government, the SEC and the IRS, right, the tax agencies, they're trying to collect taxes from these companies so that the valuation of performance affects their ability to collect taxes. And then industry associations. So industries, if you get a bunch of, it's costly to disclose a lot of information. So some industries will not want to disclose information. So we'll talk about this more in specific instances when we get through the text, and we talk about fair value accounting for one, is one where the banking industry did not want to have fair value accounting hit the income statement, so they lobbied a lot to change that law, and we created this whole separate area called other comprehensive income. And we'll get to that in more detail, but it's pretty interesting. So that's sort of this political idea of where these standards came from. And like we said, there's a broad variety of accounting standards. They came from the FASB, they came from these APB, this CAP, all these different groups. There are some that are just sort of industry norms that have evolved over time. All these things generated our accounting standards, our GAAP. And so how do we navigate that? Well, recently the FASB took it on themselves to codify GAAP. And so if you go online to this asc.fasb.org, you can get the FASB codification of all the standards of GAAP. It's a way to actually look through and figure out what GAAP is in a certain area. And so here you go. You can see this is how it's codified. You have a topic, subtopic, sections, and paragraphs. That's how you get to the detail about if you're interested in a certain area of GAAP and you want to learn more about where it came from. This is how you could navigate that system. And it's all available online at asc.fasb.org. So I encourage you guys to check that out, and hopefully that will allow you to get to, if you're interested in a financial accounting statement, it'd be a way to get to that. All right, so that is GAAP. What do you use GAAP for? We use GAAP to generate SEC filings. The main SEC filing we'll talk about is 10K, the annual report, which is what companies issue at the end of every fiscal year. It's audited. It includes all the financial information, balance sheet, income statement, statement of cash flows, and statement of retained earnings. Companies also issue a quarterly report, an interim report. In the quarterly report, they aren't audited, they're reviewed by auditors, and there's a little less information in the quarterly report. And then occasionally companies will issue 8Ks, which are interim reports that just announce big events that a company might have had. So, if they are firing their CEO and hiring a new CEO, that would be released in an 8K. These big things, SEC launches an investigation on the company, they would have an 8K. If there's a business deal, there's going to be a merger, that would be an 8K. If they're closing a plant, if there's layoffs, if there's a bankruptcy, all that stuff might be in an 8K. These things happen, not just at quarter ends or year ends, they just happen throughout time. So that's a way that the SEC allows disclosure of those material events. So those are the main SEC filings I'd like you to know. If you want to look these up, again, this is available on the SEC website. You can search for them at Edgar. It's called Edgar. And you click that link, you'll get to the financial reports for most companies. So I'd also kind of like to talk about U.S. GAAP versus IFRS. Most of the world follows IFRS, except in the United States, we follow U.S. GAAP. So they're very similar. And as we go through our class, I'll highlight some differences, if there are differences between IFRS and U.S. GAAP. But for the most part, they're the same. And there's been a push to kind of converge U.S. GAAP and IFRS, but there's still differences that exist. So, just a couple things about IFRS. IFRS has the IASB, which is basically the same thing as the FASB in the U.S. The IASB is the International Accounting Standards Board, and that's who sets international accounting standards, IFRS. One kind of interesting thing, if you're thinking of investing in a company that's a foreign company that uses IFRS, enforcement of IFRS is done on a country-by-country basis. So if you're trying to compare a company in Germany to a company in Italy, the way that IFRS has been applied in those two countries might be different, because while they have the same set of rules, the enforcement of the rules matters for how companies follow those rules. So you might not be able to compare a German company to an Italian company if the German company does a really good job of enforcing the accounting rules and the Italian company does kind of a less good job of enforcing the accounting rules. So this kind of variation can still lead to differences across countries, but it's definitely better than what used to exist before IFRS, when in Europe every country had a different accounting standard, had different accounting standards, so it was really impossible to compare one company to another company. So IFRS has done a lot to kind of make comparisons better internationally, but keep an eye on enforcement, because enforcement can differ across countries. Last thing in this chapter, just accrual accounting. Hopefully you guys remember what accrual accounting is. U.S. GAAP uses accrual basis accounting. So what we're trying to do is, not use cash basis accounting, which is what taxes are generally based on. Cash basis accounting is that revenue is recognized when cash is received and expenses are recognized when cash is paid. But accrual basis accounting, what we're going to use in this class, revenue is recognized when it's earned and expenses are recognized when they're incurred. So again, accrual basis accounting is what we're using in this class. We're not thinking about cash when it's received, cash when it's paid. We're thinking about earning revenue and incurring expenses. Okay, so I think that's sort of all I have for this chapter, and we'll move on to chapter 2, and thank you very much.